Hey everyone, welcome back to Retire on Dividends. This is Jordy, and I'm really excited to dive into today's topic because I've been getting tons of questions about this lately, and there's so much confusion out there. We're talking about YieldMax ETFs, those crazy high yield covered call ETFs that everyone seems to be talking about. I currently hold YMAX, Coney, and MSTY in my portfolio, and I want to share my honest thoughts on whether these belong in your long-term dividend strategy. First off, if you caught episode 4, you'll remember I talked about how I was using YieldMax ETFs all wrong at first. Well, I've spent the last few months really digging deeper, watching how they perform through different market conditions and analyzing what's happening with their NAV erosion. So today I'm going to share what I have learned and how I'm positioning these in my portfolio now. So what exactly are YieldMax ETFs? These are actively managed funds that use options-based strategies to generate monthly income from various underlying securities. The most popular ones focus on high growth stocks like Tesla, Nvidia, Apple, Microsoft, and in some cases like Coney, they focus on Coinbase, or like MSTY on MicroStrategy. Instead of owning the actual stock, they use synthetic positions and option strategies to generate those eye-popping yields we've all seen, sometimes 40%, 70%, or even 100% yields. And that's what pulls everyone in, right? When you see a fund advertising a 70% yield, it's hard not to get excited. But as we'll discuss today, there's a lot more to the story. Let's start with the positives because there definitely are some. First, these ETFs can generate serious monthly income. For example, MSTY recently paid a distribution with an annualized rate of over 100%. That's not something you'll find with traditional dividend stocks or even most REITs or MLPs. And another benefit is you get exposure to growth companies that typically don't pay dividends. Companies like Coinbase or MicroStrategy don't directly reward shareholders with cash payments, but through those ETFs, you can essentially create income from them. And third, some of these funds have actually performed surprisingly well during certain market conditions. For instance, MSTY has shown some impressive total returns over the past year, especially when Bitcoin has been performing well. But now let's talk about the concerns because this is where it gets interesting. The biggest issue with YieldMax ETFs is NAV erosion. What does that mean? Well, when these funds make their distributions, the net asset value typically drops by the distribution amount. Do this month after month, and you can see significant erosion of your principal over time. I've watched this happen in real time with some of my positions. While the yield looks amazing, if the underlying asset doesn't perform well enough to offset the distributions, you're essentially just getting your own money back. It's like taking dollars from your left pocket and putting them in your right pocket, then celebrating how much money you made. The second major concern is the capped upside. Due to the covered call strategy, these ETFs limit how much they can participate in the gains of their underlying securities. So if Coinbase or MicroStrategy takes off on a major bull run, Coney and MST won't capture the full upside. You're essentially trading potential capital appreciation for current income. A third issue is tax efficiency, or lack thereof. Many of these distributions can be classified as return of capital or short-term capital gains, which may create a less favorable tax situation compared to qualified dividends or long-term capital gains. So what's the verdict? Are these viable long-term holds or not? After really diving into this, here's my current approach. I think of YieldMax ETFs as tactical positions, not core holdings. They're tools for specific market environments and specific financial goals, not the foundation of a retirement portfolio. Let me share how I'm personally using them. I've limited my total exposure to YieldMax ETFs to about 5 to 10% of my portfolio. I'm treating them as satellite positions that complement my core dividend ETFs like SCHD VYM and DGRO. For Coney specifically, I increased my position when Coinbase has pulled back significantly, knowing the covered call premiums tend to be higher in volatile conditions. Then, if Coinbase has a strong recovery, I might trim some of that position and reallocate with MSTY. I've been more strategic with Bitcoin cycles. When Bitcoin experiences major corrections, I add to MSTY as it tends to offer even higher yields during those periods of uncertainty. Then, as Bitcoin recovers, I get both some price appreciation plus those massive distributions. For YieldMax, which is their fund of funds that holds multiple YieldMax ETFs, I use it for diversification within this tactical allocation. It spreads the risk across multiple underlying securities rather than concentrating on just one. Here's the most important point though. I don't drip all the distributions back into these funds. Instead, I often take those distributions and redirect them into my core long term holdings like SCHD or other quality dividend growers. This way, I'm using the high yields to actually build my more sustainable income positions. Think of it like this: these funds can be useful cash flow generators that you can strategically deploy to build your true long term portfolio, but they probably shouldn't be your long term portfolio. I've also noticed that these funds tend to perform best in sideways or moderately bullish markets. If the market goes strongly up, you're capped on the upside. If the market drops significantly, your NAV erosion can accelerate. So timing does matter with these. There's one other approach I've been testing that's worth sharing. When I believe an underlying asset is temporarily oversold or undervalued, I might open a position in the corresponding YieldMax ETF. For example, if I thought Coinbase had been beaten down too far, I might buy Coney, collect the distributions for a few months during the recovery phase, and then exit once I feel the opportunity has played out. So, to wrap this up with a simple framework for thinking about YieldMax ETFs, consider them tactical rather than strategic holdings. Limit your overall exposure. I suggest no more than 5 to 10% of your portfolio. Be intentional about what you do with the distributions. Understand that timing matters more with these than with traditional dividend investments. Have an exit strategy. Know when you plan to reduce or exit positions. One last thing worth mentioning: if you're in or approaching retirement and need current income, these can be more useful than if you're in an accumulation phase. Just be aware that the yield is often partially coming from your principal, so it's not entirely free money. I know this wasn't a simple yes, they're good or no, they're bad answer, but investing rarely works that way. These are sophisticated products with specific use cases, and they require more active management than your core dividend holdings. As always, I'd love to hear your experiences with YieldMax ETFs. Are you using them? How are you approaching them in your portfolio? Drop a comment below and don't forget to like and subscribe if you found this helpful. Next time, I'll be diving into how the recent tariff announcements might impact different dividend sectors. Which ones could be winners and which might face headwinds. Until then, this is Jordy from Retire on Dividends, and I'll see you in the next one.